Good morning, everybody, and welcome back to My Market Minute. Give me a chance to connect with you, tell you a little bit about what I think is going on in the financial markets and the economy, and what kind of strategy we are using in the investment side of things. This has been a very intriguing and interesting time. I think it's been a time of a lot going on in Washington, and I might add a lot of change going on in Washington. Hopefully it will be in time for the better. I think what we've seen in Washington is obviously the first thing is the significant loss of the Trump administration on health care legislation, which is about, maybe today, to be changed somewhat. And I think we've seen a couple other things that did not happen in Washington. We saw the outcome for the Dutch elections, and we're seeing the outcome for the French elections. It looks as though the so-called populist right wing is not going to have clear sailing. Not going to have clear sailing in the Netherlands, not clear sailing in France. And I think what the Trump administration may have learned is that they're not going to have clear sailing on anything on their agenda through Congress, so long as they maintain their position at the right side of things and are not willing to compromise. Well, what we have seen is we've seen some evidence that they are willing to compromise. We saw that the continuing resolution was passed, which will keep the government open through September. And that the Trump administration did not insist in that continuing resolution that they provide funds to build his wall, his Mexican wall. That was a compromise. Secondly, we're seeing that they're maybe making some progress on health care reform, maybe making progress. We still have the Senate to go. But again, there's some evidence that there's some willingness by the Trump administration to make some compromises. This is important. And the reason it's important is because as we look ahead, as we look past health care reform, which is an important step, as we look ahead, the real clear ability of the Trump administration to get its tax and spending plan through Congress is going to depend on its willingness to compromise. They're not going to get everything that they want, and there is some evidence that they are willing to compromise. So let's say there's been some compromise, there's been some victories, Supreme Court justice, continuing resolution, and a possibility on health care, and all of that suggests that we may get some things done. Now, nothing is going to be easy. We've got the outlines, a summary, a broad summary of Trump's tax and spending plans, tax reductions, significant tax reductions for corporations, significant changes and reductions in taxes for individuals. These are going to have a tough time getting through Congress, particularly because Speaker Ryan, as well as the Freedom Caucus, and well as others, even moderates in the House of Representatives, do not want to see any increases in the federal budget deficit and the U.S. government's debt. The tax spending plan that Trump has been rolling out does imply that we're going to have significant increases in federal deficits, maybe as much as $2.8 trillion over 10 years. So there's going to have to be some revenue raisers or offsets to the tax cuts that he's proposing. All of this is going to take a lot of time and a big struggle through Congress. Now, what does that mean? What does all of that mean for the financial markets? To a great extent, what's happened in the stock market is that it's gone up. Obviously, it's gone up in anticipation that we're going to have some significant tax cuts, that we're going to have some spending increases, spending on defense, spending on infrastructure, and that it's going to have a positive impact on the U.S. economy, like most fiscal stimulus will. So it'll be fiscal stimulus, an impact on the economy, and most importantly, an impact on after-tax corporate profits, as well as S&P 500 earnings as we look at 2018. 2018 is probably the soonest we're going to see any impact from any of this. We're going to see it enacted and any impact. So we're going to have to wait till 2018. But it will have to some extent an impact on the economy and earnings. That means higher stock prices, and stock prices to some extent have gone up in anticipation of at least some tax reductions for corporations. And as a result of that, I would say that it's pretty much discounted or reflected all of the kind of good news that's likely to be passed by Congress, if any. But I think most of that is probably already in the market, which is effectively to say that the stock market might be just a little bit undervalued, fairly valued, maybe touch overvalued, right around a fair valuation. The upside potential through 2017, 2018 is probably not all that robust. Maybe a little more on the upside, but not a whole lot. This has become a very efficient market. So that's the kind of place where we're in right now. In my judgment, doing the crunching of the numbers as we look at it, we look at the fixed income markets, the average annualized total return through 2018 is likely to be fairly flat, between 1% and 2%. The average annualized rate of return through 2018 for the stock market is likely to be something in the order of, say, 4, 5, or 6%, unless prospects for earnings get significantly better. So we're living in a very tough financial market environment, which means you've got to be really good on fixed income security selection. You've got to be good on fixed income strategy. You've got to be very good on individual stock selection, and you've got to be very good on stock or total portfolio strategy. Our strategy right now is to maintain a meaningful allocation to equities. The principal reason we say that is because we think we have, despite its length, we think we have further to go in the current stock market economic interest rate cycle. That's good news. At the same time that we say that's the general strategy, we say that in picking individual stocks and in buying individual stocks, you've got to be very patient and wait for good entry points. The current level, which is maybe pretty close to fully valued, is probably not a good entry point. We're looking for, let's say, opportune entry points, which means if we're fortunate enough to get a little bit of a pullback in stock prices, then we would add to positions that either exist in portfolios or new positions that we're thinking about adding to portfolios. What I'm saying is this is a tough financial market environment, which is exactly what you'd expect given the length of this current stock market economic interest rate cycle. It's okay. We know how to deal with this. We've dealt with it before, and we're going to work hard, really hard, in trying to make this a really successful period of time for each of us in our portfolios. Really appreciate all the confidence that you continue to show in us. We're working hard to deserve or to earn that confidence. I want to ask all of you that if you have any questions, you have any comments, thoughts of your own that you'd like to share with us, please don't hesitate to call anybody here, Dan Nolan, myself, Diane McKnight, call any of us at Hugh Johnson Advisors. We're really, the lines are open, as they used to say in the talk shows. The lines are open. We really appreciate it when you check in with us, you ask your questions, and you give us your thoughts or comments. Again, thanks for your confidence, and we look forward to working with you on an ongoing basis. Thanks again for your confidence.